Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
If you're not familiar, I'm not sure if I should take a poll, but maybe I should do that. How many people here do use pivot point analysis currently?
How many people actually use pivot analysis? I mean, John's just taking a poll.
Yeah,
yes or no? Poll. Good. Looks a lot of people responding. Please respond. Just Y or N. Thanks.
Okay, we have a few people that are using pivot analysis. It looks like more people using it than not, right? All right. First off, many people use pivot analysis, and they use them and they were once called day traders numbers, floor traders numbers, and only generally speaking, they would be used just for intraday, day trading. I've been an advocate for that I've been using longer-term pivots, monthly and weekly analysis, probably since the early 80s. And that's one of the things that when I go to trade shows, or what Steve had mentioned, I'd written many books. I've written actually 3 books, and then the Almanac series, the Commodity Trader's Almanac. And we talk about seasonalities and how to take advantage of some of these seasonal price tendencies in the moves while utilizing technical indicators such as candle triggers, such as pivot point analysis to help our entry and exits with the seasonalities. And it's really provided some very accurate forecasts in the market, which allows us to not only look at pinpointing entries, but also helps us to exit our trades and select the right strike prices, because that literally is very important. I'm sure I would poll the audience again and say how many people have predicted the right move, got in the wrong strike price, didn't see performance, and the market just moved and they didn't make money. And that's an old adage from Options Trading 101. It happens many, 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 many times. And I think if you look at more realistic, and I think that in the last 5 years with the advent of more and better educational services out there, such as what ISE does provide on an ongoing basis, I think more and more traders are becoming more professional and more savvy in their trading strategy repertoire. People just don't no longer buy out-of-the-money options and watch them expire worthless. Now they buy in-the-money options and watch them expire worthless. No, I'm just teasing. I think that a lot of people are more courageous and explore more advanced strategies, such as I mentioned, instead of buying an out-of-the-money option, go with an in-the-money option, and maybe synthetic long derivative positions. And so that's pretty unusual, and I think what really needs to be done is to discover better price forecasting tools, because many people have become more educated in how to understand the use of options. Directional trading, that's a different tool all in itself. Pivot points allow us to do that, and especially if we use daily, weekly, or more importantly, monthly time frames. If you're an option trader and you're using monthly time frames, boy, that can really help you when it comes to expirations, or at least identifying potential turns from one month to the next. Now, many people come up with various support and resistance, and there are applications out there. And as Steve mentioned, if you go to nationalfutures.com under Trading Tools, you don't have to fill out any forms or anything. Just click on Trading Tools. Drop-down menu will come up, and you'll see there's a pivot point calculator, and we do actually include the R3. Other people show, or softwares have R3 down to midpoints, and they have all these support and resistance lines on their charts. And I personally, if you do R3 and include the midpoints all the way down to S3, you can count them up on your screen, you will have 13 levels for each time period. Now imagine this. If you were doing daily, weekly, and monthly pivot analysis on your chart, and you had the R3 to S3 inclusive of the midpoints, you would have 13 lines for the day, 13 lines for the week, 13 lines per month. You would have a total of 39 support and resistance targets on your chart. And that's what I substantiate by saying I find it to be burdensome and confusing having that many support and resistance lines. Now, I think more importantly, let's take a look at this graph and how we have it laid out for you. If we're bullish, we're going to see a trend, correct? And what are we going to see with the trend? Let's check it off. We're going to see higher highs, check. We're going to see higher lows, check. We're going to see the closes close to the highs, check. We're going to see the close greater than the open, check. And generally, specifically speaking, we're going to see closes greater than past or prior highs, check. So all of these things we have, which are check, show us that the market is in a bullish trend. Folks, if we're in a bullish trend, we're going to expect to see a higher high and potentially a higher low. Agreed? If that's the case, S1 to R2, we can filter out all this excess noise, and we don't need any of this other stuff in the middle. We just can focus in on what the potential range might be for the next time period by filtering out what the condition of the market is. I don't know if that makes sense to you, but let me clear the connotations, annotations here, and we'll just say this is potentially what we could view as what the potential range of the market might be, from high to low. Many times what you see happen is the market will, the next session, open maybe a little bit lower, trade lower, and then zing straight back up. A lot of people, they see that lower open, and then they get all a little panicky, and then they see the market trade lower, and they think the end of the world's here because the market can't go up any higher, and then they find themselves selling right at support. Now, this could be for a day, this could be based on a week, and this could be based on a monthly basis. So what I like to teach people first and foremost is look to buy support and look for sell signals near resistance, especially when it's confined into these types of ranges, bullish or bearish. If we're in a bullish phase, we want to look to be buying pullbacks near support. If we're bearish, we want to look to sell at resistance. Let me show you what I mean. If we have a predicted pivot support target line, as the market starts to trade, we want to wait for the market reversal to occur based off the bouncing board or the diving board, so to speak. Wait for the market to come down to pivot and then look for a trigger or some type of setup to look for price action to reverse itself and then go with a long position.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.